You'll remember that back in June, in the peak of the Three Arrows Capital lunar debacle, I stuck my hand up and said, listen, I think it's time to buy ETH. ETH got absolutely decimated at that period of time, and we started adding to our ETH positions. I never sold anything in the bear market because my time horizon is really out to the end of this decade. So I'm looking for massive weakness to add to my positions to make as much money over time as I can, because I truly believe in cryptocurrency, digital assets, and Web3 at large. I think this is game-changing for the future of the internet. And that view of mine has been proven out as well by looking at the traditional finance people coming into the space, the famous hedge fund managers coming into this space, but also what everybody in the crypto world has built is the rails for the parallel or future financial system, and we're just migrating across to it over time. But what they've built is so profound that even the central banks themselves are going to build their central bank digital currencies on blockchain rails. Central banks and other supranational organizations are issuing bonds on crypto rails. So it really is game on. Even though we've gone through this regulatory cycle and it feels miserable, the broader adoption is happening, so much so that the old world has already admitted that the world we live in is a lot better. Anyway, we know the macro picture. I'll come a bit more onto that in a bit. But let's go through that's the big picture secular theme, obviously. But let's come on to where we are. My hypothesis, and you've heard me talk about the everything code, is that debasement of currency is the main driver of asset prices globally. Currencies are getting debased by excess printing. We all know this from crypto, that if you have too much inflation in your money supply of a token, it tends to go down a lot. And that's the same with currencies. But all of fiat currencies being debased, and that's driving the reserve currency of the dollar to get debased against asset prices. So optically, it makes things like the S&P 500, property prices, gold prices go up. Once you divide them by the debasement, or even just use the Fed balance sheet as an easy approximation, what they tend to do is operate in line with the debasement, i.e. they're just holding water. They're not making you wealthier. There's not much of an investment. It's kind of like a bond of old. But I found in my work that two things really outperformed: technology and crypto, because they've got secular adoption cycles too. Okay, so where are we in the liquidity cycle? You see a lot of noise on Twitter because everyone's starting to pick up about this liquidity. Again, I'm using liquidity here as a proxy for debasement, not just pure liquidity. I think that's less relevant. So the GMI weekly liquidity index, year on year, bottomed exactly when ETH bottomed in June. That was the first signal to me that something has changed. So that got me focused on buying ETH. Then we saw the non-confirmation of ETH when Bitcoin bottomed in November. That was really interesting to me. And that coincided with ongoing increase in liquidity. If you remember, it started with the Bank of Japan. They started printing money to buy JGBs in a process called yield curve control, expanding their balance sheet significantly. That was then followed by the Bank of England, who expanded their balance sheet to try and bail out some of the pension system and also kind of stop their bond market getting out of control. The Chinese have been slowly debasing their own currency by a slow crawl of debasement. And then we saw the US come in March when they had to quickly inject money into the banks, which they've been drawing out again. Anyway, the trend is higher, but too many people get fixated on the next chart, which is the overall trend itself, not the rate of change, which is more important. But the overall trend, well, that is the same trend as most asset prices. And that's because debasement is lowering the denominator. So what we saw is that massive rise in liquidity that happened, or debasement that happened in 2020 and 2021, and that some of that got withdrawn. But we're back basically to the long-term trend, where we've been crawling for a while now. So we're not seeing a massive shrinkage in the balance sheets. We're seeing some expansion, which is what the previous chart showed you. So that's what's driving the market higher, much to everybody's chagrin. Now, remember, a lot of people get confused about this because everyone's using different measures of liquidity. Our measure is G5 central bank balance sheets, maybe G6, and then we use a kind of net liquidity for all of those different markets, combine them into one super index, and it gives us like a 97% correlation with the Nasdaq. So it's a very good approximation for what's happening. Other people are just using Fed net liquidity. Now, that's useful, and we'll come on to that in a bit, but it's not everything, and we're starting to see divergences of things like Nasdaq from that. That's normal. What we find, and crypto will do this a lot, it will diverge from liquidity enormously because that's the bull cycle. That's when adoption goes through the roof and speculation goes through the roof, and you get the massive outperformance versus liquidity. We should expect that. If it doesn't, then it's not going to outperform the balance sheet. Remember that, right? So we're expecting to see that phase. So what is this balance sheet expansion all about? This chart is a chart I've not seen anywhere else. And that is the chart of the balance sheet, which is in white, versus in gold, it's the interest payments on the debt. And it's lagged by 36 months or leads it by 36 months. What it's telling you is that for some reason, all interest payments from 36 months ago are being paid for by debasement, i.e. they basically put them on the Fed balance sheet in quantitative easing. So what is this all about? This is to do with the Great Reset. One thing that everybody expected was a Great Reset. Well, I've now realized it happened. It happened in 2008 when all rates went to zero globally. And that essentially allowed everybody to reset their debt payments. Okay, that's like a debt jubilee. You didn't forgive the whole debt, but you basically forgave the interest payment. And everybody rolled their debts 3 to 5 years. So now we have a concentration of all government debts around the world in this 3 to 5 year sector, which every 3 to 5 years gets rolled. And that is leading to a cyclicality in the economy, that it starts slowing down because the interest payments become due, the economy starts slowing down, and eventually the central banks monetize those interest payments from the previous cycle and roll over the debt. I'm expecting the same again, and that would give us this chart. This is the future use of the balance sheet, potentially matching the interest payments to come. You can see the massive spike that was due in 2025. Those are the payments from the pandemic period. So it looks to me like there's a lot of debasement to come. It says the balance sheet gets to $12 trillion. I actually think it goes higher because I think some of the banking crisis gets tacked on. So I'm looking for something like $14 trillion from the balance sheet. Let's not get caught up in the exact projections and the exact maths. It basically tells us there's more balance sheet woes to come, more debasement, and that's very good for crypto. It also proves out the case why we need crypto, the broken financial system. Now, if you remember, Bitcoin was launched in 2008, 2009 period. That is the same period when interest rates went to zero. And guess what? The halving cycle is exactly the same as the economic debt payment cycle. They're all the same thing because they were all born at the same time. So that, I think, is the big driver. The macro is